Good afternoon and welcome to BizTech's Asian Midday Market Watch. It's the 1st of August, so we're starting the month again. And I'm Brian Fernandez, and with me is my co-host, Arsalaan Ahmed. Now, we'll start by taking a look and Oz, take us away in terms of a market update. Over to you.
Thank you, Brian. Overnight, the US stocks rallied after the Federal Reserve kept interest rates unchanged, as expected, whilst traders also poured back into the mega cap tech names. The S&P 500 jumped 1.58% to close 5,522.30, whilst the Nasdaq Composite popped 2.64% to 17,599.40. It was the best session since February for both indexes. The Dow Jones Industrial Average added 99.46 points, or 0.24%. The Asia-Pacific markets largely rose today after comments from US Federal Reserve Chair Jerome Powell indicated that rate cut could come in September if inflation data remained encouraging. However, Japan's Nikkei 225 tumbled 2.72%, whilst the broad-based topics plunged 3.45%. The indexes were mainly dragged by losses in real estate stocks, whilst heavyweight exporters also saw losses as the yen strengthened. On Wednesday, the Bank of Japan raised its benchmark interest rates to around 0.25%, marking its highest ever level since 2008. The yen fell below the 150 level against the dollar late Wednesday, strengthening 0.9% and currently trading at 149.33. Japan's finance ministry revealed that it spent 5.53 trillion yen, or $36.8 billion on foreign exchange interventions from June 27th to July 29th. The broad Asian rally comes after the FOMC meeting concluded Wednesday, where it opted to hold the federal fund rate at its current level of 5.25% to 5.5%. Powell cautioned that a rate cut is not guaranteed, though he also seemed to rule out a 50 basis point reduction. Investors in Asia are also assessing business activity data from around the region in addition to the Fed's comments, with July purchasing manager index data out from China, Japan, and South Korea. Back to you, Brian.
Now, let's look at South Korea. Now, Reuters reported that the country's exports rose at the fastest pace in 6 months in July. Now, this is according to preliminary data. Now, South Korean exports rose 13.9% year-on-year to 57.49 billion. Now, this is after a 5.1% rise the previous month. Now, however, the figure has been weaker than the 18.4% increase expected by a Reuters survey of economists. Over in Hong Kong, it saw its GDP climb 3.3% year-on-year in the second quarter, beating expectations of a 2.7% rise from economists polled by Reuters. Now, over in China, China's factory activity contracted in July, this according to the Caixin survey done by S&P Global. The country's manufacturing PMI came in at 49.8, surprising economists polled by Reuters, which expected an expansionary figure of 51.5. Now, let's take a look at some of the numbers across the region. The ASX All Ordinaries is up 0.46%. The KOSPI is up 0.66%, but the rest of the region is in the sea of red. We've got the Nikkei down 2.79%, the Hang Seng down 2.22%, Shanghai Composite is down 0.08%, the STI index is down 0.83%, and rounding up the numbers, we've got the KLCI, which is down 0.1%. Now, to bring color and additional insights to the numbers, we have our regular guest, David Kuo, founder of the Smart Investor, coming to us out of Singapore. David, as always, great to have you on the show.
Thank you, Brian. Hello, Oz.
Hi, David.
Now, for a start, David, is a Fed rate cut for September a slam dunk now?
It looks pretty much like a slam dunk. I mean, Oz was right. I mean, if you listen to what Jerome Powell had to say, he has this ability of speaking out of both sides of his mouth at the same time. I don't know of anybody who can actually do that, but he can. And on the one hand, he says it is quite likely, that interest rates will be coming down. On the other hand, he said yeah, it's still kind of data dependent at the moment. And but I have this sneaking suspicion that interest rates are going to come down in September because of this dual mandate that the Federal Reserve has. You can see that inflation is heading towards 2%. And he said in an earlier interview, it doesn't actually have to reach 2% before I cut interest rates. It only has to show that it's tending towards 2%. And then I would be happy to cut interest rates. The other thing, of course, in that dual mandate is unemployment. And there are signs that the labor market in America is starting to weaken now. So when you look at both of those things, a slightly weakening labor market, and we'll be getting some more data tomorrow, I think, from the non-farm payrolls. We'll see what that figure comes out to be. But if there are signs that the labor market is weakening, and there are signs that inflation is beginning to actually start trend downwards, then I think he will probably pull the trigger and reduce interest rates by 0.25%. And I think that was part of the reason why the American markets rallied as much as they did. It didn't quite follow through over here in Asia, though, because we have our own problems over here. Those Chinese manufacturing numbers weren't great. Contraction in Chinese manufacturing doesn't augur well for this particular region. Japan increasing interest rates doesn't really sort of do a great deal of good for those people who perhaps may have been borrowing money in Japanese yen and hoping to capture those lower interest rates. Together with the falling Japanese yen at the same time. So it's kind of a mixed bag. You said put color on what is happening in the market, Brian. But when I look at the market, it seems to me to resemble a kind of impressionist painting when you're actually too close to it. It just seems to be, it seems to be a total blur. I think sometimes you have to step, back quite a few number of paces and have a look at what is going on in the world. And quite frankly, the world's not in a great place at the moment, Brian.
Well, David, I'd like to pick your brain on something as you take a step back and look at a reducing rate environment. And what does that mean for net interest income for banks? We've seen recently HSBC's results, a big deposit taker, benefits with high rates, has got a large deposit base. But we see, it seems like rates will be coming down globally. What does that look like for banks, particularly around their net interest income line?
Well, I should be picking your brain, Oz. I mean, you're the banker. The way I see it is that the low-hanging fruit has already been plucked. I mean, for many years, because interest rates have been relatively high as a result of high inflation, the banks have been able to make money. You could make money just closing your eyes, and that net interest margin feeding through to the net interest income that the banks earn. I mean, it was just a no-brainer. I mean, banks were making a lot of money. But just lately, you're beginning to see that the banks have been pivoting slightly, and they know that high interest rates cannot remain for a long period of time. So they seem to be pivoting towards things like fee income, wealth management, and many of these banks are beginning to move into that area. We know HSBC is pretty strong in wealth management. And of course, the three Singapore banks are pretty good in wealth management as well. But what really surprised me was reading about Barclays Bank. I thought Barclays had written off Asia a long time ago, but even Barclays are talking about increasing their headcount here in Asia, particularly in Singapore and also in India, to try and sort of capture this wealth management because bankers, they can smell money a mile off us. And where there is money, a banker is not far behind. And as far as these banks are concerned, I mean, they're saying, well, there's money to be made here. Let's go in there, let's step in there and try and sort of manage these people's wealth, which raises a really interesting question. Is there too much money around at the moment? I would have thought that the space is being crowded out at the moment by so many banks all chasing after wealthy individuals. But maybe there are more wealthy individuals than we originally imagined. Maybe as a result of this quantitative easing that happened after the great financial crisis and again during the pandemic, this huge amount of money that is being created has to go somewhere. And I've always maintained that, yeah, it's easy to create the money. It's very difficult to take the money back again. And despite all the efforts of the Federal Reserve, they haven't really withdrawn that amount of that huge amount of money through quantitative tightening at all. So this money is just sloshing around the global economy, and much of it is actually here in Asia. And so I think many of these banks are saying that, okay, let's open up this new avenue of revenue and try and sort of capture the particularly wealthy people and help them to manage their money for them, which raises another interesting question, which is that if there is this amount of money, this huge amount of money swirling around the global economies, can inflation really go away? And so even though the Federal Reserve may want to cut interest rates in September, is it too soon? And when we come 2025, will inflation come back and the Federal Reserve have to reverse course and then start increasing interest rates again?
Yeah.
Now, Oz, before you ask your next question, Oz, I'm sure David and I and our audience would like to get your perspectives on this right now, as a former bank CEO of two banks.
Okay, well, look, so I would concur with what David said, or I'm going to add to it. I'm not going to go with the easy option, but I would concur with what he says around the amount of liquidity, where that liquidity is concentrated, and what you do with that liquidity in terms of looking for avenues for wealth management. I'm not entirely sure there's sufficient a number of assets out there for that wealth management without creating assets that perhaps don't have a track record, and we've seen that happen before. I think it's also correct around, the quantitative tightening and the impact of how do you manage that, and also inflation. What I'd add specifically of what I think will happen with banks is as follows. As they see rates come down, tactical moves will be made in terms of shoring up income through what they might have on their treasury books in terms of, kind of assets that go up to sell those and get a bit of a mark-to-market return. It's a typical strategy that banks will use as they try to look at deployment. And deployment ultimately becomes an issue when you have that amount of liquidity. You need to be able to put it into wealth management. You won't find enough assets to do that, that's for sure. So you'll have to look at it from the credit point of view. So when you're deploying to credit, in terms of where you deploy that, becomes the key question. When you start to combine that with some of the issues around Basel, the question is, can you really go into the real economy and the underserved? And that's a question that banks need to globally try to understand and crack. And the way to address that is using alternative data and AI in order to be able to go into underserved markets in a scalable fashion that is safe from a credit lending point of view, but also scalable and profitable for banks. I don't think that financial institutions, the large ones who have these liquidities, have those capabilities or risk appetites at the moment from their board through their management and operationally. So I don't think that is going to be a strong area that they will focus on. I think generally for the real economy, for the everyday person, for the underserved, I think it's an area the industry needs to address. So slightly more strategic answer, but in terms of the market-related stuff, I couldn't agree more with what David said.
So are you talking about infrastructure then also? I mean, will the banks try and encourage their wealthy individuals, their wealthy customers to move into things like infrastructure, which seems to be a booming area right now?
In terms of the kind of mechanisms to move into infrastructure, so if we take across the real economy side, we're talking about yes, infrastructure. That's a large bucket of it, and that cuts across different types. But we're also talking about just people who are underbanked and unbanked on the retail perspective. So you have both. In both areas, and I suppose when I'm talking about AI and alternative data, it's more on the retail side as you kind of look to provide financings and other financial solutions there. Similarly, with the infrastructure side, it's around having the correct vehicles for there to be participation in that. And again, these types of things to happen at a large scale into areas that are higher risk, it needs time. I don't think that the large banks with the large amounts of liquidity are appropriately geared to mobilize that now, and in my view.
But they also have very long payback periods, and wealthy individuals want to see instant gratification. They don't want to put something into a project that's going to take 10 years to actually sort of see some kind of return.
No, 100%. And also, when we look at some of these projects of infrastructure, some of them are not necessarily on their own, on a private basis, commercially viable. These are projects that kind of have to be done, and some of them don't follow. So again, it's that risk allocation, but also the ability to ensure that there's a reasonable return for that risk. We just don't really have the models for, on an infrastructure side, social capital, and from a retail side, the use of AI and alternative data to make decisions. But
yeah, we're going back to that impressionist painting again, isn't it? I mean, the whole world looks kind of messy right now.
Absolutely.
Now, David, go ahead, Oz.
Oh, so I was going to take a little shift of gear and go into the tech side. And obviously, we've seen a lot of movements around in the mega tech stocks. And it would be amiss of me not to ask the question, to get your views, David, on what we expect from Apple's third quarter earnings tonight. Do we have a...
Yeah, pretty interesting. I mean, for the last few quarters, I mean, Apple has been struggling slightly. It even lost its crown as the most valuable company in the world. It was overtaken by, I can't remember which one now, Microsoft or somebody overtook it. And as a result of that, people said, you know, are the best days of Apple behind it now? And I think the answer is probably no. See, part of the problem with Apple is that it's been coming out with these iPhones, and the latest one is the iPhone 15. But even I, who is using a iPhone 11 at the moment, don't feel compelled to actually go and upgrade my phone, because the iPhone 11 worked perfectly well. There needs to be something that will trigger me to bring out my wallet and to say, it's time to upgrade my phone. And going back to what you said earlier on about AI, I think artificial intelligence incorporated into the next version of iPhone 16, will be that catalyst that will actually drive people to say, yeah, it's time to upgrade my phone now. Because ultimately, what is a phone? I mean, the iPhone 11 that I had was really no different to the iPhone 8, I think, that I had previously. And the only reason I had to change the phone was because the battery was wearing out and it wasn't really lasting that long. But when you are going to be upgrading a device, it has always to be some kind of trigger, some kind of catalyst. And I have a feeling this quarter's results probably won't be that great. But I think what Tim Cook will have to say at the conference call, talking about the next phone that's coming out, is going to be the one that will spur more interest, I think, in the next iPhone. And I think we know about the network effect that Apple has, the revenue generating capabilities of its services. I mean, we all know about that, but it's really the next device. And whether that next device, that next new iPhone that's going to come out, will be able to incorporate all of those AI features, I think that is going to be the secret sauce as to whether or not Apple will be able to not only reclaim, you know, that most valuable company in the world crown, but also whether it will be able to project itself forward for the next maybe 5 or 10 years.
Now, on that note, David, thank you very much for coming on the show.
You're welcome.
Now, this has been BizTech's Asian Midday Market Watch. Be sure to keep informed on the latest market developments every day, weekdays at 1 p.m. I'm Brian Fernandez, together with my co-host, Arsalaan Ahmed, and this has been BizTech's Asian Midday Market Watch. Please like and subscribe to our various platforms and watch this on our website, as well as our syndication partners, TV stations, radio stations, and websites. Thanks a lot for tuning in.